Hello, my name is Bob Porfirio. I'm president of Wealth Preservation Assets, a firm established to bring you, the public, the information you need to get by in these days of economic uncertainty. I might add, however, that we have no political agenda. Our purpose is singularly educational, to help you preserve your assets, not sway your vote. I should also say that we're sponsored by Pacific Coin Exchange, a premier dealer in rare coins and precious metals, so don't be surprised to see little blurbs pop up throughout the webcast giving you their contact information. This morning I have the privilege again of having Mr. Tom Fisher with me, a Vice President of USCA Global Asset Management. Tom, it's good to have you back again.
Let's be back, Bob.
Listen, the last time we were talking about the advisability of owning gold or silver, whether as an ETF or physically or stored somewhere. You know, a lot of potential investors, particularly here in America, are frightened somewhat by owning these commodities because they see these fluctuations in the spot price of gold or silver go up or down. And not that stocks can't go up or down, but they seem to do this with a certain galling regularity. Do you feel there's any truth to the assertion by the people who defend owning precious metals that the price of these metals is controlled to some degree by the actions of, let's say, central banks or central governments in collusion with central banks or bullion banks by through these various instrumentalities that they have of, let's say, selling futures where there isn't any physical gold, there's simply an instrument, okay, or with what they call gold swaps, where a central bank swaps gold for currency but never delivers the gold, simply sort of leases it out or considers it a collateralized loan, and it doesn't ever show on their balance sheet. In other words, they can do these things, and presumably, according to the critics or the defenders of gold and silver, they do them in order to keep the price of these two precious metals in particular down, because if they were to rise too quickly, it would fray confidence in paper currency, particularly the dollar.
That's a tough question to
answer.
You know.
I've been putting you on the hot seat every time you've been here.
I feel the seat burning. I don't know. I know of the gold swaps, but that's simply a way of a central bank to get currency. So if a specific central bank wanted yen, they could go to the Bank of Japan and say, okay, we'll do a gold swap, and they'll pay a percentage for having the access to the yen. And the gold will still be there because they buy back the gold. So they're basically just paying a premium to get the yen, so to get the loan. I don't necessarily see that something they want to manipulate the gold markets. I doubt. I hear it all the time that the governments are manipulating the gold prices. It's difficult to see from the outside whether they
well, of course, if they were smart, it would be difficult to see from the outside.
But your opening remarks about, you know, as an investor, if you buy gold and silver, you know, it goes up and down, and you know, don't really know where it's going. Did I buy too high? Should I wait it? It's because gold has no intrinsic value. If you buy a bond or a stock, you buy a piece of the company. You buy a bond, you get an income stream. So you know what it's worth, and you get 100 when it matures. With gold, you're simply just buying gold, and that's it.
And all it has is this historical value because it's been used for currency since 3,000 or 4,000 BC. So it hasn't had a cultural thing. But you're saying, it's not a commodity that's in great demand like, let's say, oil.
No, and it's difficult to value what is the proper price of gold. I mean, I know there are some out there that do gold in relation to Dow Jones and how many ounces does it take to buy the Dow. But it has no value. It has no intrinsic value, so it's difficult to actually say what should be the proper price of gold. It all depends. But I can say, with interest rates at zero, there's no opportunity cost of holding gold. So you know, you have your money in the bank and you get nothing. You have gold. You have gold in your hand and you get nothing. So for a lot of people, it's more comfortable to have the gold.
Well, I think interest rates here in America have been down between, say, 0 and 2% long enough if that we go back when
Wow.
Greenspan was first lowering them, the price of gold was $700 an
Wow.
ounce. It's somewhere around 1,700 or so today. So they would have been better off in that sense with gold rather than earning 1% in a savings
Exactly.
account.
And
Yeah.
they do say, I mean, back in the 30s, you could buy a nice suit for an ounce in gold.
Yeah.
And you can still do that today.
Today,
So
yeah.
that is, of course, a good measurement that it keeps its value.
Let's talk about silver for a moment, because you mentioned the intrinsic value of gold is really not there, except historically. But silver, of course, is a commodity that's used a lot, particularly in technology, and more and more and more as we become a more technologically orientated world. Some, again, of the people who comment on the silver industry say 90% of the world's known reserves of current silver in the ground have already been used. So we're now, I guess they're talking sort of peak silver like peak oil. So that's a valuable commodity that's used not simply for its historical value as currency, which it has been used, but also for its industrial applications. Would you say there would be perhaps a play in silver as a commodity that is necessary and maybe more in
Sure,
demand?
I do believe, and there was also, I mean, you had the gold standard, but there was also currencies that was tied to the silver, so the silver standard. So silver is a good play. It seems much more volatile than gold, but it's an industrial commodity also. And as you say, if the reserves are falling and more people want the silver and it's used for different purposes, that should bring the price of silver back up. So I think silver is a good additional play to gold, but it's very different from gold, because gold is it's not really an industrial metal. It's just.
It has some applications,
Yeah,
and mostly it's for besides coins for jewelry. So that's.
Yeah, and I know some hi-fi freaks that have gold cables and things like that, but that's it. But not much more than that.
While we're talking about silver, and again, maybe you don't want to address this issue, but I remember recalling in one of the financial magazines, I don't remember if it was Barron's, that Morgan Chase owned 80% of the silver futures, of the world's silver futures. And as a result, they can act to, again, manipulate the price of silver. Did you have any thoughts on that?
I don't really know, to be honest. We follow silver a little bit in JGAM, but not much. So I don't really know about Chase, but I wouldn't be surprised. But I think these days, I know a lot of people talk about gold prices and silver being manipulated. I think the markets are so big, it's probably difficult, but I wouldn't put it past them, the big banks.
Of course, people have pointed out, and particularly recently this has become a matter of congressional concern here in America, that stock prices and even bond prices, but primarily equities, can be manipulated because of the instantaneous trading that can go on with computers.
Oh, yeah, the high frequency.
Yeah, the high frequency, and so people, hedge funds, whatever, the nefarious manipulators can dump a stock, and then it triggers all these trailing stops, and then the price goes down, and then they buy all the stocks that have been sold by people who set their trailing stops at whatever.
But it's not only the high frequency traders. Ben Bernanke is manipulating the stock market. He wants.
That's true.
He wants. Well, he basically wants the house prices put down, and trying to keep equity prices high.
Yeah.
Is a comfort. But that's what they believe to the population, because you have your equity wealth. The problem is less and less middle-class Americans or middle-income Americans actually hold equities. So they haven't really profited from the stock market going up, because they haven't really been exposed to stocks. But I agree, and you saw the flash crash back in 2010.
Oh, yes, yeah.
When it dropped 1,000 points in half an hour. And you always have the risk of the fat finger,
Yeah. Well, it seems that the stock market is almost a puppet now with the Fed. Every time they say, well, we're going to do something, whether it's QE3 or whatever, the stocks go up. Yeah.
we saw it after the Fed, we saw it after ECB, and stock prices went up. But, you can't keep going. I think what happened also is, the PEs are not that extremely high.
Yeah.
Companies are making a lot of profits. But they've done it on the back on cutting costs. And I think we've come to a place now where you can't actually cut costs much more in the companies. They're cut to the bone, they're sitting on a lot of cash. So unless the economy starts growing, stocks will. I mean, the central banks can only push stocks up so far.
So far, yeah. I'm going to put you on the spot again here, because some people, there's a lot of critics, of course, of QE 1, 2, and 3 in terms of debasing the dollar and also creating the world awash in dollars. I think it was Goldman Sachs that said QE3 will eventually result in $2 trillion more dollars over the long run. So some people have criticized the policy of QE3 in terms of creating a situation where the world's awash in dollars, and that the central bank, namely the Federal Reserve Bank, is simply helping Wall Street, not Main Street. To tie it in with what you said earlier, it's not helping that much the middle class. It's perhaps saving the stock market or driving stocks up, but it's not putting money back into the pocket of the person, the lower middle, the classes that are going to spend it.
Exactly, and that's the problem, because the money actually stops at the banks, and they put it back into the Fed. So it's a closed circuit. So the so-called velocity of money is low. It doesn't flow into the real economy where it is needed. But the banks also needed to show up the balance sheets, and back in 2008. And ever since, the discussion has been, should you let fall what cannot stand, or should you help? Obviously, they let Lehman Brothers fall. Some say it was a payback from Goldman Sachs.
Yeah.
But they let Lehman Brothers fall, and it's difficult, because with hindsight, they probably shouldn't have let it fall, but they were afraid of moral hazard, that if they know they're getting saved, every time they're in trouble, they don't just go out and do what they want. And if they get in trouble, they'll just say, "Oh, come and help us, we're in trouble."
That was quite a dilemma. In other words, by letting it fall, they proved to the financial institutions that you can't just depend on us bailing you out, so you can't get away with anything you want.
Yeah.
By token of the same kind, then shortly after, we did bail out the other banks, and then we bailed out General Motors and so on and so forth.
Fannie Mae and Freddie Mac.
Fannie Mae and Freddie Mac, yeah.
There was a lot of bailing out, but the system was, the liquidity, the credit, it was amazing. Money was flowing everywhere. You could get a loan, for a mortgage, liar loans. You didn't have any income. You can get, huge loans for properties, and it was a bubble. It was a huge bubble.
Oh, yeah.
And it's come down, and some argue there's still a couple of bubbles left that hasn't been
burst yet.
Which some claims the debt bubble, the U.S. Treasuries, the dollar bubble, and that could be bad. If we really see those bubbles burst. But the problem is, if you deflate one bubble, you blow it up somewhere else.
Somewhere else. That's the quandary, isn't it?
Yeah,
like,
it is.
We don't want to stop printing money for fear that this will collapse, so we continue to do.
But I think what's happening now is we're actually blowing up the bubble, the remaining bubbles, even more.
Yeah.
And it's going to burst. The bigger the bubble gets, the more pain we're gonna have. It's whether we want to take some pain now or a lot of pain later, and they're going for a lot of pain later.
Well, there is a book, I've just given it to one of our associates, called Aftershock, that is among the best sellers now, that talks about a multiple bubble collapse in the next decade or two. In terms of a perfect storm. Of course, they're predicting a major collapse in the whole global economy and being replaced with something else.
And that could happen, because what we've seen is it's the central banks around the world that's basically just pumping money into the system. It's not real growth. People are not spending any money. We all busy shoring up our own personal balance sheet.
Well, I was in real estate during the heyday under Greenspan, and I know the type of loans they made that shouldn't have been made. I saw those, and the value of houses go beyond, in America, what they should have been. And I imagine that kind of a bubble at least taught us that if you're too free and easy with credit, you're going to pay for it sooner or later.
But back then, in prior to 2008, when the real estate market kept going up, they didn't care that the loans were going to be paid back. They didn't care because they repacked it and got a AAA rating from the rating agencies and sold it to a lot of German banks, amongst others. So they didn't care whether the loans got paid back or not, because they've already resold it.
Well, isn't that the danger of hedge funds and derivatives? Because what we can do now is take anything and package it.
I think it's
and with these logarithms, the boys on Wall Street say, oh, they're safe.
I think it's Warren Buffett that says the derivatives market is the weapons of mass destruction. And he's probably right.
we just hope that explosion will come right down the line. Thanks again, Tom, for being here.
Pleasure.
Right. Okay. We hope to continue providing you with information vital to your economic security in the form of these ongoing webcasts. You can get even more information on the website of Pacific Coin Exchange in the form of blogs and e-newsletters. Thanks for spending some time with us.